Welcome back to the Daily Crypto Deep Dive. Something is happening in the crypto market right now that most people are only seeing at a surface level. But underneath, there is a much bigger structural shift taking place. And if you understand this shift early, it completely changes how you look at Bitcoin, Ethereum, XRP, and the entire crypto market going forward. Because over the past week, three major developments have started to converge at the same time. XRP has moved out of years of regulatory uncertainty and into a position that looks far clearer. The SEC has begun drawing actual lines around how crypto assets are classified. And at the exact same time, Wall Street, led by firms like BlackRock, is accelerating its move into crypto infrastructure and financial products. Now on their own, each of these stories matters. But when you put them together, you get something far more important than just news. You get alignment. And when alignment happens in financial markets, that's when real change begins. This is no longer just another crypto cycle. This is a transition. And to understand where we're going, we need to break this down properly, starting with XRP. For years, XRP has been one of the most debated and uncertain assets in crypto. Not because of its technology, and not because of its use case, but because of one single issue: regulation. The entire market has been waiting to see how XRP would ultimately be classified, because that classification determines everything. If XRP were treated as a security, it would fall under strict regulatory frameworks, heavy compliance requirements, and limited accessibility across exchanges and institutions. That would restrict its growth and make it far less attractive to large-scale investors. But if XRP were treated more like a commodity-style asset, similar to Bitcoin, then it would be free to operate across global markets, integrate into financial systems, and attract institutional capital without the same restrictions. For years, that uncertainty acted like a ceiling. It didn't matter how strong the technology was or how clear the use case seemed. Institutions stayed cautious. Exchanges were hesitant. Investors priced in risk. And in financial markets, uncertainty is often more damaging than bad news. Bad news can be quantified. It can be priced in. But uncertainty creates hesitation, and hesitation kills momentum. Now, for the first time in a long time, that uncertainty is starting to lift. XRP is increasingly being treated as something much closer to a commodity-style asset, and that shift changes how it can operate within the financial system. It changes how institutions view it. And most importantly, it changes how capital flows toward it. Because once regulatory clarity begins to form, the biggest barrier disappears. And when that happens, the conversation changes. We're already seeing analysts move away from questioning XRP's survival and toward discussing its role. What does XRP actually become if it is allowed to operate freely within the system? What position does it take in a world where crypto is integrated into finance rather than sitting outside of it? And the answer to that question is where things get interesting. Because XRP is not trying to be everything. It's not trying to compete with Bitcoin as a store of value, and it's not trying to compete with Ethereum as a smart contract platform. XRP is focused on a very specific role: financial infrastructure. It is positioning itself as the rails for moving value. Cross-border payments, liquidity bridging, settlement between institutions. These are not small use cases. These are trillion-dollar flows that exist within the global financial system every single day. And now, with regulatory clarity improving, XRP becomes far more viable in that role. Because institutions don't just look at innovation. They look at compliance, risk exposure, and long-term viability. They need to know that whatever they integrate into their systems will not create regulatory problems down the line. And that's exactly what has been missing. But now, that is starting to change. At the same time this is happening, we're seeing a second major development: the SEC beginning to draw actual lines around crypto. For years, one of the biggest criticisms of the regulatory environment has been the lack of clarity. Everything existed in a gray zone. Projects didn't know how they would be treated. Investors didn't know what risks they were exposed to. And institutions had no clear framework to operate within. But now we're starting to see structure. Assets are being categorized. Some are being treated as commodities. Others are still being assessed as securities. Stablecoins are being positioned as payment instruments. Now, this framework is not perfect. It is not fully complete. And there are still gaps that need to be addressed, particularly when it comes to legislation and enforcement. But direction matters, and the direction is clear. Crypto is no longer being ignored or pushed aside. It is being defined. And that is one of the most important steps any emerging asset class goes through. Because markets do not grow in chaos. They grow in clarity. Once the rules begin to form, capital begins to flow. And this is where the third piece of the puzzle comes in: Wall Street. Because while all of this regulatory clarity has been developing, institutions have not been waiting. They have been preparing. And the clearest example of that is what we are seeing from firms like BlackRock. BlackRock is not just investing in crypto. It is building infrastructure around it. It is creating products that allow traditional investors to access crypto in familiar ways. And one of the most important developments here is the move into Ethereum through structured products that incorporate staking. Now think about what that actually means. For the first time, investors can gain exposure to crypto and earn yield from it in a way that fits into traditional financial models. This is not just speculation anymore. This is income. This is portfolio allocation. This is something that can be measured, modeled, and integrated. And that changes how crypto is perceived. Because once something starts to generate yield, it moves into a completely different category of asset. It starts to compete not just with other cryptocurrencies, but with bonds, equities, and other income-generating investments. And that is where institutional capital starts to take it seriously. BlackRock and similar firms are not chasing hype. They are building systems. They are creating the framework that allows crypto to sit alongside traditional assets in a structured, scalable way. And when you combine that with what is happening with XRP and the SEC, you start to see the bigger picture. This is alignment. XRP gaining clarity makes it usable. The SEC defining categories makes the market understandable. BlackRock building products makes it investable. And when something becomes usable, understandable, and investable at the same time, that is when scale happens. But this is where we need to slow down and really understand the implications. Because there is a fundamental difference between a market driven by retail investors and one influenced by institutions. Retail markets are fast. They are emotional. They are driven by narratives, hype, and momentum. They move aggressively, both up and down. Institutional markets are different. They are structured. They are strategic. They are driven by long-term positioning, risk management, and capital allocation. And that means the behavior of the market changes. This is the moment crypto stops being retail-driven and starts being institutionally controlled. Now, that does not mean retail disappears, but it does mean retail is no longer the dominant force. Institutions bring liquidity, but they also bring influence. They influence narratives. They influence flows. And ultimately, they influence price behavior. And they also introduce new variables. Macroeconomic conditions become more important. Interest rates, inflation, and global events start to have a stronger impact on crypto. We are already seeing signs of this. Bitcoin reacting to inflation expectations. Crypto markets moving alongside traditional risk assets. Volatility being driven not just by internal events, but by global conditions. The idea that crypto exists in isolation is fading, and what is replacing it is integration. Crypto is becoming part of the global financial system. Now that creates opportunity, but it also creates complexity. Because while institutional adoption can drive long-term growth, it can also lead to more controlled environments. More measured moves, more sensitivity to macro conditions, and potentially less extreme volatility over time. It also raises questions about control, because when large financial institutions hold significant influence over a market, they do not just participate, they shape it. And that is something the crypto space has not fully experienced yet. For years, crypto has positioned itself as an alternative to traditional finance. But now, traditional finance is entering crypto. And that changes the dynamic completely, because now understanding crypto is not just about understanding technology. It is about understanding finance. It is about understanding capital flows, macro trends, and institutional behavior. And this is where positioning becomes critical. Because in a market like this, not all assets behave the same way. Bitcoin is increasingly being treated as digital gold. Ethereum is evolving into a yield-generating financial layer. And XRP is positioning itself as infrastructure. Each asset has a role, and those roles matter. Because that is how institutions think. They do not chase narratives. They allocate capital based on function. And that is exactly what we are seeing now. Which brings us back to the bigger picture. Because when you combine XRP gaining clarity, the SEC defining the landscape, and BlackRock building infrastructure, you do not just get a market cycle. You get a transformation. A shift from uncertainty to structure. A shift from speculation to integration. A shift from retail dominance to institutional influence. And these kinds of shifts do not happen often. But when they do, they reshape entire industries. And that is what this feels like. Not just another cycle, but a new phase of crypto. A phase where it becomes embedded in the financial system in a way it never has before. And the people who understand that early are the ones who position themselves correctly. Because the question now is not whether crypto will grow, it is how it will grow. And who will control that growth? Because from everything we are seeing right now, Wall Street is not coming. Wall Street is already here. Drop your thoughts in the comments. Smash like, follow, and we will see you at the top.